Greetings, members one and all of the Salivation Nation. Goldman Sachs says that gold is no longer a store of value. Let's explore. There's probably a little bit of multiple personalities disorder or schizophrenia over there at Goldman Sachs, because I was reading a couple of different articles today from Kitco, and the commodities research team there, they're basically predicting that gold is going to hit $2,000 an ounce this year, and that the upside move really is just beginning. And I tend to agree with that. They're saying that gold is now, again, pricing a Goldilocks scenario of moderate inflation and continued global recovery, and thus trading at a large discount to the current real rate. Current gold price is consistent with the real rate of 0.1% or negative 0.87%, which is currently priced by the market. In their base case that the global recovery continues uninterrupted and inflation remains subdued, they expect this discount to persist, and we see just a modest upside to gold, driven by only a small increase in real rates and a continued improvement. Over the past couple of months, gold has been strongly correlated with the inflation fear factor. Prices therefore corrected sharply after the hawkish Fed surprise, which our economists interpret as the Fed taking a more backward-looking interpretation of average inflation targeting. This has not only reversed the inflation trade, but also removed the market's pricing of inflation tail risks. In a scenario where the global economy recovery does not play out as expected, or inflation begins to move materially against expectations, they see material upside to gold given its undervaluation and low allocation from the investment community. So given that statement, it's quite interesting that they would take another stance here with another article that says that gold is not this optimal store of value. And then they mention in this report about cryptocurrencies that they've increased from about 2,000 with a market capitalization over $200 billion in late 2017 to over 8,000 with a market capitalization of about $1.6 trillion. So yeah, and then they also talk about the S&P 500. This is their actual statement about gold, which is really an all-of-front attack. This, from 2010, focus on commodities, especially oil and gold. Gold was touted as a much-needed asset to hedge against the inflationary impact of loose monetary and fiscal policies after the global financial crisis, and therefore against the likely debasement of the dollar. The argument for gold in the aftermath of the crisis was identical to the argument for cryptocurrencies, cleverly marketed by some as digital gold as a result of the pandemic. We, in other words, Goldman Sachs, recommend against an allocation to gold, oil, or commodities in aggregate, showing that they were not an inflation hedge and that gold was not a store of value. Then they go on to mention the S&P 500 index has outperformed gold by 327 percentage points, or 10.7 percentage points annualized over the past 11.5 years. Adding, many have touted holding cryptocurrencies as an alternative to holding gold. And obviously they recognize that Bitcoin's not perfect, but to compare gold to Bitcoin or the S&P 500 is wholesale foolish and an ignorant way to view gold in that comparison strategy, because they are different strategies, completely different strategies. And that is the thing that Goldman Sachs is missing here, while on one side of the mouth talking about how gold is a great hedge against inflation, and then the other side saying that it is not, foolishly comparing it to the S&P 500 and to cryptocurrencies. What are cryptocurrencies? The only similarity between gold and the cryptocurrencies is that they are decentralized. And the thing is gold is always decentralized. Other than the actual physical gold held in the vaults by central banks, that is a centrally stored location of that gold. You and I will not see that gold unless it's rehypothecated or taken out of the market and or taken out of that market into the global gold market. That's the only way we'll see that gold. But nonetheless, like the gold that you see before you here, these gold pieces are indeed here, and they are decentralized. Cryptocurrencies are as well, but only for now. In other words, there is great fear, and understandably so, that potentially Bitcoin and other cryptocurrencies could be taxed, or they could come under some draconian regulation by central planners and governments around the world. They can't do that to this gold, or to silver for that matter. It is truly decentralized and always will be for the gold that you hold in your hand. And save for an invasion of your home where it's taken from you by some government official, well, they're going to have to get that through my cold dead hands as far as I'm concerned. But nonetheless, the distinction and obviously the performance of cryptocurrencies has been out of this world, crazy insane, but that's because they're being treated as investments, and that's what they are. They are speculative assets, digital assets is what Bitcoin is. The S&P 500, well, that's the market. That's another version of the market that is a speculative investment. And, you can look at any particular period of time and measure the performance of a stock or an index or a commodity of any sort and measure it against gold or anything else over a particular period of time, and you can make a case against gold in that regard. But one thing is for sure, over the test of the history of what gold has been for literally thousands of years, the S&P 500 does not have that. Bitcoin certainly doesn't have it. And pretty much any other tracked commodity out there doesn't have it, save for maybe copper. But even as such, copper being utilized as money, in fact, it is the only metal of any metal out there, of any commodity, that is still being used in our money and being used as currency these days. No other metal has that, but I digress. Gold is the ultimate store of value. It is the ultimate stable store of value and has proven itself against inflation and any other economic instability that may occur through the long course of time. Now, obviously, the timing of its performance within the midst of a crisis or at the beginning of one or at the tail end of one can make an argument against it in that particular period of time. But this metal, because of the nature of what it is, was not meant to be day traded. It's not meant to just hang on to and right when we're in the crisis, sell it. You hold on through it, hopefully throughout the crisis, so that it protects you in the case that you need to sell it. Now, obviously, there are cases and times where the economic impact of a particular situation may affect people at different times, depending on their personal economic situation, because here in America, we are horrible at saving, and that gold and silver provide a great way to save and to prepare for such disasters economically that may occur. Therefore, it is incumbent upon us as Americans, I believe, and for anyone around the world, but we Americans are especially bad at it, to have some savings. And have some savings even outside of gold and silver. There's nothing wrong, even though it is a depreciating asset, there's nothing wrong with having a little bit of cash in your portfolio. And I'm talking about not just in the bank as in a savings account, but I'm talking about outside the banking system on your person. Because it's better to burn through this than have to burn through that. Better to burn through this than that. Because it's like this and like that and like this, Anna. And that's how we do it. We hold on to it for the duration. That's the beauty of gold, and you do pay a premium in order to do that, but more than likely that premium will dissolve and disappear as the price of it goes up. And we know that has happened in the past and will continue to happen in the future. We will see the price match up with the true value of what the metal is. And no one knows exactly what that is until time has a way of making that apparent to us all. Therefore, I believe it is wise to us to not follow the advice of Goldman Sachs, especially when they're one side of them saying is that gold is not a good store of value. But hey, we can pay attention to them when their commodities people are talking about gold reaching $2,000, and I think that's probably the disconnect there between the different. After all, Goldman Sachs is a pretty big bank, so it's probably not surprising that we'll see two different mouthpieces talking about it. Nonetheless, the commodity side, I think, knows the deal. We've seen them. They've actually made some pretty bold predictions in the past. I've covered that on this channel, and so we can kind of separate them from the others. But even as such, people wonder if there's not an agenda behind some of their predictions, and there very well could be. Regardless of what agenda is out there by anyone, one thing we know for sure is we have the test of time. History is on our side, and we will continue to stack and hold these precious metals, and because we know what they mean, we know what they're worth, and that worth will continue to reveal itself the longer we hold on to it. Let me know what your thoughts are in the comment section below. Would like to extend a multitude of gratitude to you all for taking the time to watch, and encourage you to please rate, share, comment, and subscribe.